This is a video on finding stocks that multiply your wealth by 100 times. Any investor who finds and holds on to even a couple of such multi-baggers in their portfolio is likely to become wealthy, immensely wealthy, in fact. But is this extraordinary result even possible for ordinary investors? In our earlier video on 100 baggers, I have shown how it is possible to find such stocks by covering the factors that make stocks 100 baggers. For the purpose of this video, we can summarize the points as under: small size, scope for valuation re-rating, consistent double-digit growth in profits, and excellent management are the 4 criteria that help investors find multi-baggers. While knowing the attributes of multi-baggers helps investors to buy these stocks, the investor also needs to build the right temperament and skills so that he can hold on to them and also sell them at the right time. To truly benefit from 100 baggers, investors need to have the right vision to spot them, the courage to buy them in size, and the patience to hold them. To make sure that they hold on to only long-term compounders, investors need to know when to sell them. This can only happen if they know the source of returns of stocks and can identify when these sources are drying up for a stock they own. The rest of this video will cover these 2 important topics of investor attributes and sources of stock returns. Once an investor gets these 3 things right, then the chances of creating life-changing wealth multiply many-fold, and you will be well on your way to finding and, more importantly, benefiting from 100 baggers. Having covered the important pointers Mayers mentions in his book in the previous video, let's delve a bit deeper into the investor attributes that allows investors to buy and hold onto these multi-baggers. An investor who can hold on to 100 baggers needs 3 key attributes. These are the vision to spot them, the courage to buy them, and the patience to hold them. 100 bagger stocks are like marathon runners and not sprinters. They have the fortitude and strength to generate growth over multiple decades. To do this, they have a few qualities like a moat which protects them from competition, a high return on equity, and high gross margins. In addition, investors can look for some of the catalysts for high growth. These include high industry growth rates, the company growing faster than competitors, or moving up the value chain, the company doing huge capex, or expanding distribution. The second attribute of great investors is the courage to buy these 100 baggers in size. Many investors have spotted 100 baggers, but less than 1 in 100 such investors is able to profit from them. One of the main reasons for this failure is a lack of courage in buying them in size. So many investors who spot multi-baggers either under-allocate their capital to them or sell out too soon, thus reaping only a small part of the gains from such stocks. So, investors should display courage and fortitude and buy such stocks with a reasonable allocation in their portfolio. The rarest of the 3 qualities is the patience to hold multi-baggers once you have them in your portfolio. Having done the hard work, all an investor needs to do is to hold on to a bunch of these stocks, as even a single 100 bagger can create life-changing wealth. By just following the performance of the company and thinking like a business owner, the investor can hold on to these stocks for multiple decades. Having covered the temperament and skills investors need to inculcate, let us next turn to understanding how investors can calculate the source of stock returns. You will recall from our introduction that this is important so that investors can sell stocks that no longer meet the criteria for 100 baggers. Let us start by understanding the source of these returns. There are 3 primary sources of return for a shareholder. These are: 1. The current earning yield per share, 2. The growth in these earnings with time, and 3. The increase in the valuation multiple paid on those earnings. So to take a concrete example, take a company like Asian Paints. Let's say the company had earnings per share in 2013 of 12 rupees per share and the average share price was rupees 480. So The earning yield of Asian Paints in 2013 was 12 divided by 480 or 2.5% approximately. Now, Asian Paints has grown its profits threefold in these 10 years. If we annualize this profit growth, it works out to 12% per year. Finally, the valuation multiple on those earnings for Asian Paints was 40 then and is 70 now. This means that the market places a higher value on 1 rupee of earnings of Asian Paints today than it did 10 years ago. This translates to a growth of 6% per year. When we add these three sources, the share price growth of Asian Paints has been 2.5% plus 12% plus 6%. This works out to slightly above 20% per year. However, this does not guarantee the investor 20% returns a year in the future as well. To start with, Asian Paints may not continue getting revalued higher as its growth rates may not warrant a higher multiple. Secondly, if the paints market sees higher competition, Asian Paints may not be able to grow its market share as it has been doing in the past. Thirdly, the investor will need to assess the size of the total addressable market in paints. As you can see, by looking at the source of returns, we are immediately forced to assess many important aspects of whether the stock is a potential 100 bagger from here. If you would like me to cover the important topic of total addressable market, please message TAM in the message box below. This concludes our series on 100 bagger stocks.